Good morning. Thank you for joining Mayor Brown's Global Financial Markets teleconference series. Today's call covers revisions to the aspects of the Volcker Rule that relate to covered funds and the structured finance industry. My name is Tom Delaney, and I'm a partner in Mayor Brown's Financial Services Regulatory and Enforcement Group based in Washington, D.C. I advise both domestic and international financial services firms on a wide range of regulatory compliance matters, including permissible investment. I'm privileged to be joined today by three outstanding colleagues, Jeff Taft, Carol Hitselberger, and Matthew Bisanz. Jeff is also a partner in the firm's Financial Services Regulatory and Enforcement Group and our office practice leader here in Washington, D.C. His practice focuses primarily on regulatory matters as well as receivership and insolvency issues, consumer financial services, cybersecurity, and privacy issues. Carol is a co-leader of Mayor Brown's banking and finance practice and splits her time, when not under COVID-19 restrictions, between our New York and Charlotte offices. Carol focuses on structured finance transactions and spends significant time on accounting and regulatory developments, including bank capital considerations that impact structured finance deals. Carol works with investors and issuers on a wide range of structured finance transactions, including trade and credit card receivables, mortgage and other consumer loans, aircraft leases, and franchise portfolios. Matthew is a senior associate in our Financial Services Regulatory and Enforcement Group. He is also in the Washington, D.C. office. He counsels U.S. and non-U.S. financial services firms on banking regulations, insolvency and resolution issues, cybersecurity and data privacy concerns, as well as financial technology. First, a couple of housekeeping items. As regular listeners will know, this call is being recorded. We will be emailing an audio link to all participants should you wish to listen to the teleconference again or forward it to your colleagues. Since we will not have a question and answer session, please send your questions regarding today's topic by email to gfm@mayorbrown.com, and we will respond promptly. This is the same email address on your invitation email. With those brief introductions and instructions behind us, we will now begin today's discussion. On June 25th, the U.S. banking agencies, along with the SEC and the CFTC, finalized revisions to the covered funds provisions of the Volcker Rule. The final rule largely follows the revisions that were proposed by the regulators on January 30. If you recall, in August last year, the agencies adopted a final rule that primarily focused on restrictions governing proprietary trading. The rulemaking we are discussing today is the bookend to that regulation in that it addresses the other key aspects of the Volcker Rule, which is prohibitions that apply to banks dealing with entities that the rule defines as covered funds. The revisions, which take effect on October 1, address many of the implementation and compliance issues long identified as problematic with the existing regulation and reflect intense engagement on the part of the structured finance industry. My colleagues will cover these aspects in greater detail. However, it is worth pointing out that while the final rule largely adhered to the proposal, it deviated from the proposal in the following key respects. The final rule adds a new exclusion for family wealth management vehicles that permits family wealth management vehicles not organized as a trust to be owned by up to 5 closely related persons of the family customer rather than 3 as proposed. A U.S. banking entity and its associated parties may own up to 24.9% of the ownership interest in a foreign public fund that is sponsored by the U.S. banking entity instead of up to only 14.9%. A loan securitization vehicle may hold certain debt securities that represent up to 5% of the aggregate value of the securitization vehicle's assets. A qualifying foreign excluded fund is not subject to the Volcker Rule compliance program requirements that are otherwise applicable to banking entities. A banking entity may enter into riskless principal transactions with a related covered fund, regardless of whether that covered fund is a securities affiliate as defined in Regulation W. Unfortunately, as is often the case when dealing with complex regulations such as the Volcker Rule, not all good comments were adopted in the final rule. As a result, while the final rule reflects helpful progress, it is not likely to be the final word. At this point, I would like to ask Carol to take us through the parts of the revisions that are of greatest relevance for structured finance.
Thank you, Tom. As we all know, covered funds are intended to capture hedge funds and private equity funds, neither of which resemble the types of issuers used in securitization. Moreover, the Volcker Rule itself provides that the implementing regulations for the rule should not interfere with the securitization of loans by banks. Consequently, I am happy to report that after 10 years since the initial adoption of the Volcker Rule as part of Dodd-Frank, the revisions will now permit CLOs, which are and have been the predominant vehicle for the securitization of loans in the capital markets, to be executed without undue compliance burdens resulting from the Volcker Rule's covered funds provisions. That is because the revisions have addressed the biggest compliance burdens for CLOs and other asset-backed securities by narrowing the scope of ownership interest so that it will now exclude most customary debt exposures, and the loan securitization exclusion, or LSE, has been relaxed to accommodate more common CLO and other ABS issuers. The changes are largely consistent with those proposed in the Notice of Proposed Rulemaking, published 6 months ago, with some additional adjustments and clarification. I will first address the helpful revisions to the LSE. The existing loan securitization exclusion excludes certain loan securitization vehicles from the definition of covered funds if they hold only loans and certain loan-related rights and assets. The revisions will permit an issuer relying on the LSE to hold debt securities other than ABS and convertible securities of no more than 5% of the issuer's total assets, generally calculated based on par value at the time of acquisition. This responds to industry requests for bond buckets to be permitted to be held by LSE issuers, but is technically a more narrow bucket than in the proposal, which would have permitted any non-loan assets to fill the 5% bucket. However, in response to lingering industry concerns, the preamble to the revisions explicitly clarify that operating leases as well as leased property, including end-of-term residuals, should be permissible assets for an LSE issuer. The preamble states that a change in the text of the rule is not necessary because leases are already included in the definition of loans and thus are already permitted assets under the current exclusion. Therefore, notes the preamble, any residual value of leased property upon expiration of an operating lease should constitute an asset that is related or incidental to purchasing or otherwise acquiring and holding loans. The revisions also helpfully codify an FAQ issued by the agencies in 2014, which addressed a typo in the regulation by stating that while a servicing asset may or may not be a security, if the servicing asset is a security, it must be a permitted security. Without this correction, the only servicing assets technically permitted to be held by an LSE would be permitted securities. Also, the revisions relaxed the tenor requirements for cash equivalent assets that may be held by an LSE issuer, providing that such cash equivalents must correspond to the outflow needs of such an issuer, but eliminated the requirement that they be short-term. Of course, all the helpful changes to the LSE follow through to the exclusion for certain qualifying asset-backed commercial paper issuers as well, otherwise known as the QABCP exclusion. The revisions do not suggest any modification to the requirement that an issuer relying on the LSE be an issuer of asset-backed securities. This has been a hurdle for some CLO issuers during their warehouse finance phases prior to issuing any securities. Helpfully, as Jeff will describe in greater detail, the revisions offer up a new covered fund exclusion for credit funds, which could fill that void. Next, I will discuss the revisions that narrow the definition of ownership interest. The regulation defines an ownership interest in a covered fund as any equity, partnership, or other similar interest. An other similar interest is defined by reference to a broad list of characteristics, which arguably include certain standard provisions in debt instruments. One of such provisions, the right to participate in the removal or replacement of a controlling party, such as a collateral manager, when no event of default or other acceleration of the debt exists, is a typical right for senior investors in the debt issued by CLO issuers. To address this issue, the agencies made a clarifying amendment to the definition of other similar interests and created an express safe harbor for certain senior loans and senior debt instruments. As contemplated in the proposal, the revisions modify the scope of the definition of ownership interest to allow for certain additional rights of creditors that are not triggered exclusively by an event of default or acceleration without such interest being deemed to be a Volcker ownership interest. The revisions expressly permit a creditor to participate in the removal or replacement of an investment manager for cause. Although the revisions define in significant detail what events may constitute cause, we believe that the enumerated events are consistent with the market generally and consequently should result in most senior debt exposures to CLOs not to be ownership interests subject to the Volcker Rule. The agencies also clarify in the preamble that a debt interest in a covered fund would not be considered a Volcker ownership interest solely because the interest is entitled to receive an allocation of collections from the issuer's underlying financial assets in accordance with a contractual priority of payments. While consistent with the approach taken by the market since the Volcker Rule regulations first took effect, this clarification should provide more certainty to industry participants that hold debt instruments issued by special purpose entities whose sole source of payment are their collections on their financial assets. Finally, following from the proposal, which in turn reflected industry comments, the revisions create a safe harbor from the definition of ownership interest for any senior loan or other senior debt interest that meets certain of the characteristics included in the definition of other similar interests. Notwithstanding industry requests, the agencies declined to define senior for this purpose, which may limit the availability of the safe harbor in practice. In sum, however, the revisions are very helpful in easing the compliance burden for banks that make loans to and invest in debt securities issued by CLO and ABS issuers alike. Over to you, Jeff.
Thank you, Carol. With my time today, I'm going to briefly discuss the changes to the existing exclusions for foreign public funds, small business investment companies, and public welfare funds, and the new exclusions for credit funds, qualifying venture capital funds, family wealth management vehicles, and customer facilitation funds. First, the revisions modify the current exclusion for foreign public funds by updating relevant definitions, requirements, and limitations. To help ensure that foreign public funds qualifying for the exclusion are sufficiently similar to U.S. registered investment companies, the revisions modify the definition of public offering to add a new requirement that the distribution be subject to substantive disclosure and retail investor protection laws or regulations in the jurisdiction where it is made. The revisions limit the requirement that distributions comply with all applicable requirements in the jurisdiction where they are made to only apply in instances when a banking entity acts as sponsor, investment advisor, investment manager, commodities trading advisor, or commodity pool operator of the fund, addressing potential difficulties faced by a banking entity investing in a fund sponsored by a third party. Finally, the revisions also eliminate the restrictions on selling ownership interests in a foreign public fund to employees of the fund or its sponsoring banking entity or a fund or their affiliates other than senior executive officers. Second, the revisions also clarify how the exclusion for small business investment companies applies to SBICs that surrender their license during wind-down phases. They do this by specifying that the exclusion for SBIC, CIBICs, continues to apply to an issuer that was an SBIC even after it voluntarily surrendered its license to operate as a small business investment company, so long as it does not make new investments after such voluntary surrender. This expanded exclusion, however, is not available for an SBIC that has had its license revoked. The revisions build on a question from the proposal by clarifying that the exclusion for public welfare funds is available for any fund whose business is to make investments that qualify for consideration under the regulations implementing the Community Reinvestment Act. Finally, rural business investment companies and qualified opportunities funds that are established under the Opportunity Zone program from the Tax Cuts and Jobs Act were mentioned in a request for comments to the proposal and are addressed in the revisions through the creation of new exclusions for rural business investment companies and qualified opportunity funds. As noted, the final rule adds 4 new exclusions to the definition of covered fund. As previously discussed by the industry in the 2017 Treasury Report, the definition of covered fund is very broad and not well tailored to the stated underlying objectives behind Section 13 of the Bank Holding Company Act. These 4 new exclusions are the latest attempt to more carefully tailor the covered fund definition. As with many of the exclusions under the Volcker Rule, the requirements are very detailed, and we're only providing a high-level overview of each one today. As noted by Carol, the first exclusion is for credit funds that make loans, invest in debt, or otherwise extend the type of credit that banking entities may provide directly under applicable banking laws. A credit fund is defined as an issuer whose assets consist solely of loans, debt instruments, related rights, and other assets, and certain interest rate or foreign exchange derivatives. While the agencies had previously considered an exclusion for loan funds, they ultimately decided it was unnecessary given the other exclusions for loan securitization entities, joint ventures, and subsidiaries. As detailed by the industry on various occasions, this was not true, and an exclusion was both needed and appropriate. For many credit funds, these exclusions had proven to be problematic. For example, the loan securitization exemption was not available because the credit fund was not typically issuing asset-backed securities. In certain circumstances, the credit fund and loan securitization exclusions will likely work in tandem. The credit fund exclusion is subject to certain conditions and limitations. Under this exclusion, a credit fund may not engage in activities that would constitute proprietary trading as if the fund were a banking entity or issue asset-backed securities. Additionally, the availability of the credit fund exclusion is subject to compliance with other conditions that are designed to limit the banking entity's exposure to the activities of the credit fund, such as not allowing the fund to hold any debt securities, equity, or rights to receive equity that the banking entity would not be permitted to acquire and hold directly. The second exclusion is for qualifying venture capital funds, which is defined as an issuer that meets the definition in Rule 203L-1 under the Investment Advisors Act of 1940, and that does not engage in proprietary trading as if it were a banking entity. In order to rely on this exclusion, any banking entity that acts as sponsor, investment advisor, or commodity trading advisor to the venture capital fund is required to comply with other conditions that are designed to limit the banking entity's exposure to the activities of the venture capital fund, such as not guaranteeing, assuming, or otherwise ensuring the obligations or performance of the venture capital fund. A venture capital fund exclusion was something that the U.S. Treasury Report in 2017 identified as a way to assist in the formation of venture and other capital that is critical to fund economic growth in the United States. While the agencies had previously considered such an exclusion, it was never included in the original Volcker Rule or any subsequent amendments. In the proposed rule, the agencies considered additional restrictions on the venture capital exclusion, such as limiting it to funds that did not invest in companies that, at the time of the investment, have more than a limited dollar amount of capital or total annual revenue. Ultimately, the agencies decided not to impose additional limitations on the use of this exclusion in the final rule. The third new exclusion is for family wealth management vehicles. Under the exclusion, a family wealth management vehicle includes any entity that is not and does not hold itself out as being an entity or arrangement that raises money from investors primarily for the purpose of investing in securities for resale or other disposition or other trading in securities, provided that if the entity is a trust, the grantors of the entity are family customers, and if the entity is not a trust, a majority of the voting interests are owned directly or indirectly by family customers, and the entity is owned only by family customers, and up to 5 closely related persons of the family customers. As Tom noted at the outset, this is a slight change from the proposed rule, which allowed only 3 closely related persons rather than 5 in the final rule. Under the revisions, this exclusion is available to banking entities only if it or an affiliate provides bona fide trust, fiduciary, investment advisory, or commodity trading advisory services to the family wealth management vehicle and complies with other conditions that are designed to limit the banking entity's exposure to the activities of the fund. Finally, the fourth new exclusion is for customer facilitation vehicles. This exclusion is available for an issuer that is formed by or at the request of a customer of the banking entity for the purpose of providing such customer or one or more affiliates of such customer with exposure to a transaction, investment strategy, or other services provided by the banking entity. The condition that the vehicle be formed by or at the request of a customer does not preclude a banking entity from marketing its services through the use of customer facilitation vehicles or discussing with its customers prior to the formation of the customer facilitation vehicle the potential benefits of structuring such services through a vehicle. As with other exclusions, the banking entity must comply with conditions that are designed to limit the banking entity's exposure to the activities of the fund, such as requiring all ownerships and interests in the fund be owned by the requesting customer. And with that overview, I'll turn the program over to Matt now to address some of the other changes in the final rule.
Thank you, Jeff. I will address the remaining notable changes to the Volcker Rule, which relate to the banking entity issue for foreign excluded funds, Super 23A, and parallel investment issues. The recent revisions address the long-standing banking entity issue by creating 2 new exemptions for qualifying foreign excluded funds that codify an earlier agency policy statement on the same topic. Under the new exemptions, a qualifying foreign excluded fund is exempt from the prohibitions against proprietary trading and covered fund activities if it meets certain criteria, such as being part of a bona fide asset management business and not being used to evade the general requirements of the Volcker Rule. Further, foreign excluded funds are no longer required to have Volcker Rule compliance programs or comply with the Volcker Rule's reporting and documentation requirements. However, they remain subject to the Super 23A prohibition. Turning to Super 23A, the revisions address the prohibition against covered transactions with certain covered funds by authorizing banking entities to engage in covered transactions with a related covered fund that would be exempt from the quantitative limits, collateral requirements, and low-quality asset prohibition of Section 23A of the Federal Reserve Act as implemented in Regulation W. Such exempt transactions include making correspondent banking deposits, giving credit for uncollected items, and transactions secured by cash or government securities, among others. However, the final revisions clarify that a banking entity must comply with all of the elements of an exemption as set forth in Reg W to rely on it in the Super 23A context. This may prevent some banking entities from relying on certain exemptions, such as those that are premised on the covered fund being a securities affiliate of the banking entity. The revisions also permit a banking entity to provide short-term extensions of credit to and to purchase assets from a related covered fund, subject to limitations that are similar to those that apply to the intraday extension of credit exemption in Regulation W. Further, in a change from the proposal, the revisions add a new exemption to the Super 23A prohibition for riskless principal transactions. This exemption is similar to an exemption that already exists in Regulation W, but has been tailored to work better in the context of the Volcker Rule. Moving beyond Super 23A, The revisions clarify that a banking entity need not include investments made alongside a covered fund in the banking entity's per fund and aggregate fund ownership limitation calculations, as long as certain conditions are met. The clarification takes the form of two rules of construction, the first of which is that the banking entity is not required to include in the calculation of the investment limits under the asset management exemption any investment the banking entity makes alongside a covered fund, as long as the investment is made in compliance with applicable laws, regulations, and safety and soundness standards. The second rule of construction is that the amount of any investment the banking entity makes alongside a covered fund is not restricted under the asset management exemption, as long as the investment is made in compliance with applicable laws and regulations, again, including applicable safety and soundness standards. Overall, the revisions represent a meaningful step toward rationalizing the Volcker Rule. The revisions include several changes that were requested by the structured finance industry, as well as some other changes that are likely to be welcomed by banking entities. However, as others have noted, there remain several areas in which the Volcker Rule can be further refined. For example, two SEC commissioners noted in their statements on the revisions that the revisions did not exclude long-term investment vehicles from the definition of the covered fund. This is a potential exclusion that, if implemented, could facilitate economic growth in these uncertain times. We expect that the industry will continue to engage on these types of issues with the regulators, most likely after the federal elections later this year. And Tom?
Thank you, Matt. I'd like to thank you, Carol, and Jeff for taking the time today to share your insights on the revisions to the Volcker Rule. I'd also like to thank our audience for tuning in today. Two brief reminders. You will receive an email with a link to the audio recording of today's call, and the recording will also be available as a podcast on your preferred podcast platform. Lastly, as mentioned before, if you have any questions related to today's content, please email them to gfm@mayorbrown.com. Thank you again for your participation. You may all now disconnect.